Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. Thanks for following us to Wednesday. This is something new for us, probably a one-time thing due to some scheduling issues, but we're happy to be here, and we certainly have some interesting job numbers to talk about from Friday. Before I get started, I wanted to say we're thinking of all of our friends in Western North Carolina and throughout the Southeast who are recovering from one hurricane, and our friends in Florida, some of the same folks who are preparing for another hurricane. Our thoughts are with you today. We will have our Chief Economist, Gerald Cohen, on in a moment to talk about the recent job numbers and the effect they may have on the Fed and a lot of other things. Until we get to that, though, let's give you a quick run through of the show. Dr. Cohen's presentation will last for about 15 minutes, and then we'll move on to questions from the audience. If you're a member of the media and want to ask a question, please do. You might also include your title and organization with your question so that we can make sure to prioritize it, make sure that it gets answered. If you're joining us by phone today, you can also ask a question. You can do that by emailing me at rob_knapp@kenan-flagler.unc.edu. We will be looking to wind this up as we usually do in 30 minutes at about 9:30 Eastern. We'll see how we do. There is a lot to talk about, and we will try to get all of your questions in and get those answered before we finish up today. So without further ado, let me introduce our Chief Economist, Gerald Cohen, who's with us this morning to talk about Friday's job numbers, not this morning's job numbers, and a lot of other things. Gerald, good morning. Hope you're doing well today.
Morning, Rob. Let me just make sure my video is, there we go.
I see it.
Doing great today. Now let me share my screen so I can start the presentation. And always the hardest part of any, and I think we should be a go. So as the title indicated, I want to talk a bit about how the employment report affects the Fed. I do want to kind of put things into a bit of perspective in terms of both the employment report and some of the ways that we think about, or I think about, the Fed and kind of inflation dynamics. So I think that should take me well over, or at least the 15 minutes that we've allotted. So I'll start because I had the time to digest the employment report, to kind of give some key takeaways that, as the title indicates, the employment report caused the markets, or as that previous slide indicated, to reassess the path of Fed easing. And the Fed may be doing the same thing. And one of the reasons is because not only was this employment report strong, but we had in the week before that a very significant upward revision to GDP. And this raises questions about the amount of slack in the economy. And so if there's not a lot of slack, or if the economy is growing above its potential growth, then that should indicate upward inflationary pressures. And so I'll kind of illustrate where that comes in and how that could affect the Fed. And it wouldn't be a discussion about economics for me without talking about productivity. And so one of the keys to low inflation is whether productivity is growing at a healthy pace. And so that's allowing greater potential growth in the economy. And so we'll kind of illustrate that in a couple of different ways. So this data, on Friday, we saw 254,000 jobs created, much stronger than expected, upward revisions in the previous months. And, I've been quite pessimistic, or relatively pessimistic about the economy. We've been seeing these downward revisions. And so the upward revisions were quite positive, illustrative that the economy is, you could question, I'm asking the question, is the economy slowing at all? On net, if you include the greater than expected payroll numbers and the revisions, the job market was 175,000 stronger than the expectations. So you had a stronger report by about 100,000 and then upward revisions by about 70,000, 75,000. And so those two combined to not just make a strong report, but the employment picture looks even stronger than expected. One thing I want to point out, though, was that payrolls suggest that the economy isn't slowing, but there's another part of the report, which is the number of hours worked, and that actually fell in the month of September. And you can see that there's this relationship. I think I've talked about this, GDP is comprised of the number of hours worked and the productivity of those hours worked. So I've kind of decomposed that. And you could see that right now, hours worked are relatively slow, but the question is GDP going to continue to grow? And that gap has to be filled by productivity growth. In the kind of 21, 22, hours were growing strongly, productivity was quite weak, and that's how you got healthy GDP. In this case, it's been more about productivity and less about hours. And this productivity, again, will come into play in terms of how we think about inflationary dynamics. So one other thing to point out, and I don't know, I'm going to argue both directions. It's a potential source of strength or weakness, is that roughly 3/4 of the jobs created in the last month and over the last year have been in leisure and hospitality, healthcare, and government. More on the healthcare and government side, but you've seen a pickup in leisure and hospitality jobs. So if you think about the sustainability of job creation, by the way, only about 40% of jobs on average are in leisure and hospitality, healthcare, and government. So these three sectors are punching well above their weight. And then there's this question of sustainability. So healthcare is a growing sector as we're an aging population. So you might imagine that's an area of growth, less likely to be recession prone. So that's a positive. Government is an open question about whether you can continue to sustain these jobs. I mean, in the near term, given FEMA, given the terrible, what's occurred from the hurricanes, we're feeling it, as Rob said, in Western North Carolina, where you're seeing Milton headed towards Florida. There's going to be a demand for government workers. So that might continue to be an area of growth. And then there's leisure and hospitality. And what's notable is that leisure and hospitality is actually finally above its pre-COVID peak. Every other sector in the economy has kind of well surpassed that. But this is an area where, because of job shortages, or shortages of finding workers, it's taken a very long time to get above that pre-COVID peak. And the question does that mean that this is an area that is primed for continued growth, or is it that it's still hard to find people, or we filled all those jobs and it's going to be hard to find people? And I'll talk a bit about the job openings numbers in a second as a measure of slack. So I've stressed this many times, and the fact that temporary help jobs are historically a leading indicator of economic activity. If you think about it, the first person you hire is likely to be, if you're not sure about how things look, on the upside, you're likely to hire somebody that's a temp. The first person you're likely to let go because you don't have any contractual commitment is likely to be a temp. And so that's the reason for this relationship. There's been a whole discussion about nurses, that were temp help workers. Much of that discussion has gone away. So I guess my question for the audience, and I'm grappling with this, is what am I missing? Why is this indicator trending downward while the job market continues to be strong? The unemployment rate, somewhat related to the strength of the job market, ticked down to 4.1%. This was actually the result. We've had some wiggles and waggles as a result of, the decline, increases or declines in the labor force. This was a positive tick down, decline in the unemployment rate, a rise in the labor force, all good signs. And I've talked about this before, the SOM rule, which is a kind of a rule of thumb, which suggests that you look at the change in the unemployment rate relative to its low over the last year, and that remains breached. So that the unemployment rate is still a 0.5 percentage point above its 3-month average low during the year. And that historically, as you can see in this chart, has been an indicator, a real-time indicator of a recession. This data says it's hard to imagine we are in a recession. The question is, as the unemployment rate, the theory is as the unemployment rate goes up, you're at a turning point where it starts to affect people's behavior, spending behavior. So as people are laid off, they become more cautious in their spending. And historically, 0.5% has been the kind of the dividing line, but it's clear that it's not going to be there at this juncture. As I indicated, and kind of related to the unemployment rate, is the amount of slack. And in the week before, at the end of September, the Bureau of Economic Analysis released data suggesting that, or indicating that the economy was actually grew more or is larger than previous indications. So the blue line here is the upwardly revised number. The orange line is what we thought GDP was prior to that revision. And that is suggests that the economy is 300 billion larger, or 1.25% percentage point larger than we thought. And that raises this question about how much slack we have in the economy. So taking the unemployment rate and the GDP numbers, we can create a measure of slack. So I'm comparing the green line is the unemployment gap, which is the unemployment rate relative to an estimate of what's called the NAIRU, the non-accelerating inflation rate of unemployment. In other words, the amount of the unemployment rate and which means that the economy is going to continue to grow without unemployment. At 4.1%, the unemployment rate is slightly below the Congressional Budget Office estimate of the NAIRU, or the kind of full employment rate, and that suggests that the economy is growing, or that there is not enough that there is a little bit. There's less slack, or actually negative slack, or what we would call kind of a or that the economy is running too hot. So if the unemployment rate is below that NAIRU number, that full employment rate, the economy is running hot. So that's the green line. The blue line and the orange line are estimates also based on the Congressional Budget Office estimate of the potential of the economy based on GDP. And those suggest that the economy also is running too hot. But the question is it 2.5 percentage points too hot, or 1.25 percentage points too hot, or just a tad too hot? And that really matters for inflation, because if the economy is running hot, meaning we're using more resources than we have at our disposal, that's going to lead to higher prices. So this is a really important factor in how the Fed and how I think about the economy. Now, there's no perfect answer on this, so that's why I have 3 different indicators. These all could be completely wrong, and again, if productivity is stronger than we expected, those blue and orange lines are actually lower. But let's see what happens if we put it into my Taylor rule model of the Fed. So I've talked about this model before. It's a model that was created by John Taylor, an economist at Stanford, as a kind of a rule of thumb of the Fed. You can see the red line, and I'm sorry, there are a lot of colors. The red line is the federal funds rate. The blue and the green and the yellow lines are estimates of the Taylor rule based on this kind of simple mathematical formula of what the Fed should be doing. And you can see that the red line, the the Fed has cut rates by 0.5 percentage points. If we take the Fed's estimate of what they're going to do, which is the gray line after the forecast dotted vertical line, you can see the expectations are the Fed is going to cut rates. Now, the question is, if you take different models of the economy of slack and you use the Fed's own forecast, what do these Taylor rule models get? And so the blue and the yellow orangish line are based on GDP, and those, the gap of either 2.5% or 1.5%, and the green line is a gap of 0.1%, and then again following what the Fed's forecast is. So all of these suggest that the Fed should be easing, but they also suggest that the Fed maybe should not be easing, or should not be easing as much as they would have, as they are saying. And some of this is based on new data that we've gotten, and since the Fed last met, and since the Fed created their last economic forecast. So what I'm trying to illustrate here is the Fed rethinking because of being data dependent, because of the data that we've seen in the economy. Tomorrow we're going to get inflation numbers, which again will be, are they continuing to decline to the Fed's 2% target? Are they leveling off? Are they rising? If there's not a lot of slack, then you're going to see, or if if we're above that full employment level, we would expect to see upward inflationary pressures. So as I said, the markets, because after this data, reassess their expectations. They're now basically in line with the Fed, but the question is, are we going to continue to get data, or is the Fed going to reassess it even further and talk about that reassessment? To date, they have not. Another measure of slack, and I realize that I'm just about out of time, is this job openings and job quits rates. And I want to just stress two things. One is on the openings. I talked about leisure and hospitality. Openings levels have come down, but are still very high historically, suggesting that there's still jobs out there for people who are looking. But interestingly, quits have fallen and kind of look like they're at levels that occur during recessions, or as we're going into recessions, which suggests that people are more worried about their prospects because they're less likely to quit. Finally, I just want to spend a few minutes talking about inflation dynamics. So what we're seeing in this chart is that wages are growing faster than inflation, which potentially, and I say potentially, implies that that companies that are paying higher wages are going to have to raise their prices and raise inflation. But the mitigating factor is productivity. And I know there's a lot of wiggles and waggles in this chart, but what I'm trying to illustrate here is, if you look in the 95 to 2005 period, you can see the blue line, which is wages, or a broader measure called compensation, was much stronger than unit labor costs, which is what it costs businesses to actually hire that or pay that labor. And that is adjusted for inflation. So this positive gap between the blue line and the orange line suggests that you could pay higher wages because these workers were having higher productivity. In the 2010s, you could see the gap was effectively zero, which meant that productivity was very weak. And so wages had to grow in line, or unit labor costs had to grow in line with wages. You've seen this gap open recently, and that's because of strong productivity data. And the question is that going to continue? Are we going to get wage gains that are above inflation, but are they going to be mitigated by productivity? So, as in many cases, productivity is the magic elixir that will both allow the economy to grow with limited labor force growth or limited hours growth, and allow the economy and allow wages to grow faster than inflation. So let me stop there and open it up to questions.
And I apologize, Gerald. I almost always say, Dr. Cohen will have 15 to 20 minutes. And today I said 15 minutes. So if you had to cut an absolutely magnificent slide out of that presentation, I apologize. And we can go back.
No. I was just about where I wanted to end. I have a few more on consumer spending, but I kind of think that it's a great place to stop.
Okay, all right, you hit the mark then. Good job on that. Again, folks, we are taking your questions. You can send us those using the Q&A function at the bottom of the screen. If you're with us by phone today, you can email them to me at rob_knapp@Kenan-Flagler.unc.edu. We've got a couple of good ones in the hopper right now. Howard Schneider asks, what do you make of the wage result in September, and what do you expect moving forward, particularly in the context of possibly higher productivity?
So, thanks for the question, and more than happy to discuss productivity. So let me just we can talk about the drivers of wages, and that's this question of slack, and also, but I kind of talked about, and maybe I'll just go back to that chart to illustrate the kind of maybe two competing measures of slack, just using the job openings. So strong job openings, a relatively high, so that blue line is quite high relative to history, suggests that that workers have bargaining power, because if they want to, they can leave to find an opening, and that suggests not a lot of slack or full employment, and that would mean that people have bargaining power and could ask for higher wages. Then you have the orange line, which is that quits are quite low relative to history. And by the way, they are on two different scales, just so you know. The right-hand side is the quits, the left-hand side is the job openings rate, or the scales. And if quits are low relative to history, that means that people are saying, wait a second, I'm not willing to leave my job because I'm not going to find something that's as good or better, which means that people have less bargaining power. So, so I realize that I'm talking like a typical economist on the one hand, on the other. So this picture can tell two different stories. The strong employment numbers suggest that people have bargaining power because there's job growth out there, which suggests upward inflationary pressures, and then if you have upward wage pressures, and then but that could be mitigated by strong productivity. And so and I shouldn't even say mitigated. What I really mean is that if people are more productive, they should be paid for that output, and that's how, in theory, economics works. So you can be paid more because you are being more productive. You're creating more output per hour of work that you put in. And so it's a bit of, we don't know what the wage outlook looks like. The strong employment reports suggested which should continue. These measures of slack suggest it could or it may not be because of the quits rate. And then the question is what's happening to productivity. And I will tell you, we don't know. Productivity is extremely hard to predict, especially on a quarter-to-quarter basis.
The magic elixir is very hard to predict.
Exactly.
This is a question that came in while you were answering that one, and you touched on it for a moment, I think. But attendee asked, to what extent does full employment spur productivity gains?
So that's a great question, and I think that in some respects we're seeing this in real time, and partially this goes to the structural issues, and one of the reasons why this openings rate may be high is because of structural rates because of demographic factors. That means that there's less labor out there on a structural basis. So you might see more openings historically because, as opposed to in the past when, 200 people were fighting for a job. Now it may be 2 because of demographic factors. And so that, given that it's harder to find labor because of demographics, or potentially harder to find labor for demographics, businesses are going to substitute capital, i.e. invest in robots or, tablets. Think about ordering in a fast food restaurant that you now do it on a tablet as opposed to a person. Or I think McDonald's has a machine now that makes great French fry, a robot that makes great French fries. And so full employment does spur that investment that raises productivity. But as I'm happy to discuss, and for those of you that are attending our Frontiers conference tomorrow, I'm going to have a panel about this. One of the questions is, how do we get it's the relationship between investment and productivity, or innovation and productivity, is a very attenuated one. So there's and given the limited time, I'll happily at some point discuss this relationship, but given the limited time, maybe I'll just say it's difficult to know when we're going to see on aggregate productivity gains from these investments.
Okay. This one goes back to the portion where you're talking about the temporary employment. Does temp help employment primarily reflect the slowdown in manufacturing that we've seen over the past 2 years?
It's a good question. I would say, it's hard to know where temps are working. I don't think we don't have that data, or at least I haven't looked. It's been a while since I looked at this. If you looked at manufacturing, you would see a flat to down employment picture. And that is another area of weakness over the last year or so. And that is, kind of a cyclical trade, really, global issue. So there's a cyclicality, and there's a in the US, and there's a global issue. I think, some of this, and now some of this was nurses became kind of temp help workers, or they were, and you've seen that kind of rise and then fall off. But I don't know the answer. I suspect it's not all manufacturing. I think it's other things. And it could go to this labor shortage issue, in that people are saying, like, I need workers. I want them to be on my payrolls so that I can keep them. And so maybe they're finding people are starting as temps, and they're being rolling into full employment. But it's hard to know. And I suspect it's not. I think there's some manufacturing component, but I suspect it's not all manufacturing.
Okay, thanks. Looks like last question of the day goes to Dan Barkin from Business North Carolina. Dan asks, should we pay a lot of attention to weekly jobless claims as an indicator, or are there problems with it?
So great question, Dan. I appreciate it. So I pay very close attention to the weekly jobless claims. It's the best kind of real-time indicator we have out there of the job market, and maybe even the economy overall. The challenge is twofold. The first is that we're only seeing the one side of it, which is the layoffs. You're not seeing quits, and you're not seeing hires. Generally, jobless claims follow the business cycle, and I don't have a chart with me, but I could. Actually, I might have had one. I might have one that I won't bother. But it doesn't have a long history, I think, of where you can see, how this relationships. But there is a tight relationship between the unemployment rate and jobless claims. But the other challenge is this question about the dynamics of the economy, and because of this kind of demographics and labor shortage, the question is, are we just seeing, and we've seen this in the last 10 to 15 years, that jobless claims are at, kind of have been lower than historically, especially if you think of the level, which is about 225,000 per week, relative to the size of the labor force. So claims have been very low, and in the last 15 years, we've effectively seen 10 or 15 years, we've seen one recession, which is COVID, and you saw this huge spike. And so we don't have enough data to say, is this a new structural issue? But I think people are talking a lot about whether structurally you're going to see lower levels of claims. You still should, I still watch whether they're rising, and they are quite volatile. So I look at the 4-week moving average of claims, but the kind of the magnitude of the gain may be smaller, or the kind of the signal to noise ratio may be larger or lower, that less signal and more noise.
Okay. Thanks very much. It's been quite a morning. We did a briefing on a Wednesday. We had 5 colors on one chart. We're constantly pushing the boundaries around here. So,
I apologize, Rob, for that. I know that is a complicated chart. I usually don't show that many lines, but I wanted to kind of illustrate a bunch of different measures. So I apologize for that.
No, I can only tell you it looked great on my screen.
That's great to hear.
So thank you very much to Dr. Gerald Cohen for his great insight, as always, on what's going on in the economy and the workforce. Thanks to all of our audience who found us on a Wednesday. We appreciate you coming with us. To those of you in the audience from the media, we'd love to continue the conversation. If you'd like to talk to Dr. Cohen or any of our experts about any of the topics we've talked about today, please let me know. You can find me at rob_knapp at Kenan-Flagler.unc.edu. For everyone in the audience, we'd love to have you visit our website. We're at Kenan-Institute.unc.edu. Always a lot of things going on there. As Gerald mentioned, we have something going on tomorrow. It's our annual Frontiers of Business conference. So we hope to see a lot of you there. If we don't, we will see you next month on Friday, November 1st, for the next monthly briefing. Again, thanks for being with us this morning, and have a great rest of your Wednesday.